Welcome to the latest episode of our podcast series for financial advisors. Today's episode is a mid-year report on deals, transitions, and recruiting. It's a special industry update with my partner, Jason Diamond. I'm Louis Diamond, and this is the Diamond Podcast for Financial Advisors.
This podcast is designed for advisors like you who are interested in learning more about the evolving wealth management industry through candid dialogue with breakaway advisors, those from the C-suite, and industry thought leaders. It's available on our website, diamond-consultants.com, as well as Apple Podcasts and other major podcast platforms. So be sure to subscribe and share it with your colleagues. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade. And each year, 25% of transitioning advisors who manage $1 billion or more are our clients. Curious about where, why, and how advisors like you are moving? Download the latest Advisor Transition Report to learn more, including intel on recruiting deals and our insight and analysis on the latest trends in the wealth management space. You'll find it at diamond-consultants.com/transition report. Or if you'd like to talk, feel free to give us a call at 908-879-1002.
It's hard to believe that we've passed the midpoint of the year and are already gathering data for our next transition report. And it's going to be another massive effort for our team because 2024 is proving to be an incredibly active year. Based on what we're seeing, the pace of transitions is currently surpassing 2023, which is why we felt it was important to share a mid-year report using our trademark data-driven analysis and insights on what the current state of recruiting looks like, what we're seeing in the way of deals, and dive into some of the most noteworthy transitions to date. Plus, we'll take a look back at how our predictions for this year are faring, and then set our sights on what we expect for the final quarters. Will the flow of movement continue? What events could trigger a change in activity? Can we expect changes to deals? There's a lot to talk about, so let's get to it. Thanks for joining me, Jason.
I'm thrilled to be here. Thank you, Louis.
All right, so let's dive into it. I know you've been deep in the lab analyzing recruiting data like you always do, but have done some work to figure out what movement was like in the first 6 months of 2024. So why don't you just take a couple minutes and share some of your key takeaways?
Yeah, I would love to. So first of all, whenever we do these reports, I'm a little bit cautious because I think the raw data, while it's helpful, it can be a little bit misleading. And I feel like this year, the beginning of this year, is a little bit of a case where the data is a little misleading. The raw movement numbers are still very high. We're seeing actually more movement year to date than we saw for the same period last year. But anecdotally, and what we're hearing from many of our client firms is that things have indeed slowed down a little bit, at least at the middle to upper reaches. I think what we've seen in a lot of the movement data is the quality and length of service of advisors moving is a bit on the lower end. And obviously, we use length of service as a proxy to gauge experience or to gauge quality of advisor. But what we really care about is the revenue or the assets that are in motion. And it feels like that has ticked down at least a little bit relative to the same period last year. And one of the things we'll talk about today is the impact on recent cash sweep policies and whether that could be a catalyst for a recruiting slowdown, because it's certainly been top of mind for a lot of folks in the industry. But for today, I think what I want to do is, if you'll allow us to, is revisit some of our predictions that we made in the last report, just to take stock of where we are, how did we do, what are our predictions as we look ahead, and then certainly we'll talk about the raw data as well.
Absolutely. If you have the number, I'm curious how many experienced advisors, however you define that, moved in the first 6 months of the year?
If you recall from our report last year where we published the full year 2023 report, there was north of 9,000 advisors in motion. this year, when we looked from January through June, and again, remember, we're only looking at advisors with more than 3 years length of service, we saw a little north of 6,000 advisors in motion, which obviously just back of the envelope math would mean 12,000, give or take, advisors moving this year, which would obviously well outpace last year.
Interesting. But you're saying that just anecdotally and just thinking through what we're hearing from our clients and seeing in the space, that even though there's more advisors who have moved, that it feels like movement is maybe a little bit down, especially when you talk about larger, more experienced, long tenured teams.
That's how it feels to me, and that's how it feels in dialogue with our client firms. Let me turn the question around to you, and even forget the raw data. Just what's your sense from being in the market all day, every day? How do you feel like recruiting activity has been for the first half of the year?
To me, I would say it feels similar to 2023, where we're still seeing very large corner office teams move. We've seen a lot of mega independent firms either launch RIAs and leave the broker-dealer world or change broker-dealers. So to me, I feel like there's been a number of monumental transitions that have happened, but I was a little bit surprised to hear that there's more advisors have moved so far in the first 6 months of the year compared to the same period in 2023. So I think we feel extremely bullish that advisor movement will continue, and we'll get into the reasons why. And I think when we do this episode again at the end of 2024, I expect that movement data is going to be similar or even more robust in 2023. So I still think advisors are moving. They're moving for similar reasons that they always have, looking for more autonomy, more control. There's certainly more options for teams than ever before. Deals are at an all-time high. The market is cooperating right now. So all of the wind at the sails that recruiting typically needs is there. So I think it's going to be a really strong end to the year.
I don't disagree. I think the backdrop is certainly there. It's interesting. We have heard from a number of our client firms that things feel slower. And to me, I think part of that just stems from there is so much legitimate competition out there more than ever before that, yeah, it probably does feel slower if you survey any one or group of firms, because where advisors are going is so dispersed. And it certainly includes the wires, it includes the regionals and the boutiques, but as you mentioned, the entire spectrum of independents as well.
Yeah. And I think too, there's some very significant M&A activity, especially with independent broker dealers. If you look at Osaic, which is the former advisor group, acquiring Lincoln Financial, we saw a lot of advisors not go along with that transaction and have moved to firms like LPL and Commonwealth and into the RIA channel. So some of the numbers too, it's not artificially inflated, but I think there's some episodic kind of lumpiness to advisor movement, which is just the nature of it. I think too, another point that's important is the major firms, especially the wirehouses, have gotten way better at figuring out ways to retain advisors. The sunset deals that they have are by far the most compelling retention tools they have at their disposal. And those deals are getting pushed earlier in an advisor's career, locking up that advisor pretty much in perpetuity. And then the deals at some levels have gotten larger, and the firms and management are just more aggressive with positioning the deals to their advisors. And when a team is considering a deal like that, it locks up the inheriting team for 5, 7, even sometimes up to 9 years. And then the retiring advisor is pretty much agreeing that they're never going to work in the industry again. So I think we'll see that dynamic continue, especially when it comes to the wirehouse world.
Well, and it begs an important question, I think, which is to my point earlier about what we really care about is quality or assets or revenue that's in motion, not just headcount, is maybe looking at this through the lens of wirehouse advisors in motion is a better way to view advisor movement, because generally the wirehouse advisors are the largest and the most quality. And we'll see when we discuss the raw data on the wirehouse side that those headline numbers are not quite as strong. I agree with you. We've still seen some massive marquee headline grabbing, news grabbing moves. But it's interesting when we think about a lot of the movement data, it does seem like the raw numbers, a lot of those just on a headcount basis are in the independent space. I think we'll focus today. Most of our remarks will be probably a little bit more geared towards the employee side of things, the wirehouses and such. So to that end, let's dive into some of our predictions that we made in the 2023 report. So the report we published at the beginning of this year, which covered the entirety of last year. And one of our major predictions was that we would see private equity interest in wirehouse teams accelerate and become a real disruptive force. And I know this is a topic that you're passionate about. So what are your thoughts? Did we nail this one?
I think we did. It's too soon to tell with looking at movement data if this trend is actually causing disruption and changes in kind of the tide of competitive recruiting. But in our many conversations with the biggest and best wirehouse teams, it comes up in most conversations. And we've seen probably 8 to 10 very successful large national RIA firms backed by a private equity sponsor proactively come to us, rolling out interesting deal structures and raising their hand and saying, we think we're a great home for wirehouse teams. And we've been thoughtful about how we structure deals. And as a reminder for anyone who forgot or hasn't listened to previous episodes, what's really different and interesting about how private equity looks at recruiting teams is that deals are at long-term capital gains. For the most part, it's looked at as an asset purchase or an acquisition of the business. So there's no forgivable notes for better or worse. It does lock up teams who sign these deals pretty much in perpetuity, similar to a sunset deal. But the deals on a pre-tax basis are typically stronger than a traditional wirehouse deal, and they include a meaningful amount of equity. So an advisor who is bullish on their ability to move their business because they don't offer as much cash up front. Most of the deal proceeds will be based upon what comes over in the first few years of the transition. Those teams can really hit the bid on multiple levels. They get a meaningful cash payment at capital gains, and then they get a major equity grant that ideally will be monetized for a much higher number down the line. So I think this trend will continue. These deals take longer than most deals do. And I think it's like a rock rolling down the hill. It's just starting to pick up momentum. It'll start to pick up pace as it gets further down the hill. And more advisors see friends and colleagues go this direction, and firms get more intentional and more active with going after wirehouse teams and not just focusing on acquiring RIAs like they have in the past.
Yeah, I think that's spot on. Is we're going to see it's a copycat industry. And so the more proof of concept we have, the more big teams that go this route, it's only going to spur others to follow suit. And this is a little different than what we're talking about now. But if you need any other evidence that private equity is here to stay in our industry, at the time of this recording, it was last week or the week before, KKR announced the purchase of Janney. So pretty clear that private equity is here to stay in the wealth management industry. And I think there's benefits to that. I don't say that pejoratively. Moving on. So I'll tackle this one. We posited back in the 2023 report that advisors would need to offer more differentiated services because competition is great. And we speak a lot about competition for advisor talent, but the reality is there's a lot of competition for end clients as well, right? Advisors need to be proving themselves day in and day out. And this prediction, I absolutely think we nailed. When we speak with not just independent advisors, but wirehouse advisors too, it's actually become a catalyst or a driver of movement is the desire or the want to offer these ancillary services, things like trust and estate, tax prep, bespoke investment opportunities. We had a podcast guest on this year. They spoke about allowing their clients to invest directly in barrels of bourbon, other unique products and solutions. So I think we're only going to see this play out more. The reality is the wirehouses are fantastic places for a lot of reasons. They offer full service, great brand, safety, security, stability. But when it comes to a lot of this ancillary service type stuff, like trust and estate, like tax, I guess maybe said another way, anytime you want to color outside the lines, that is really not where the wirehouses shine. What are your thoughts?
Yeah, no, I think that's right. The desire to offer more to clients is typically the guiding light of advisors who break away, but it also weighs on the mind of advisors who feel like they're well served at a banker or a major firm because maybe they have clients that are asking for these services, or in an ideal world, they'd love to offer them. So it doesn't mean that if you really want to offer these services that you have to go independent. There's still plenty of ways to offer more to clients, whether it's through partnerships with CPA firms and the like, and being more of the outsourcer of outsourcers type model. So it's not that you have to be independent in order to offer these services, but certainly if you want to insource these activities into your firm and generate revenue on them directly and really make it look like a client can do everything just with your organization, that typically points towards the independent space. So I think this will continue. And advisors always ask, and we always guide advisors, you can only make a transition if it's going to be better for clients. So as advisors think about whether a move makes sense, this is a really clear and tangible example of how you can do better for clients and offer more. So I think this will continue, and it doesn't mean that advisors have to start doing tax returns. There's a lot of creative ways to form a JV with various folks, to acquire an existing practice. or to hire folks to do it. So I think that this will continue. It's a great prediction that's certainly coming true.
Yeah, absolutely. Let's talk a little bit about succession, because this to me, I think we probably said this in the report, and it's certainly true today. This to me is going to be the issue. I mean, we talk about cash sweeps and we talk about regional banking crises. Those are issues of the moment. I think this succession issue is going to be the issue now and well into the future. I mean, you've seen some of the demographic stats around what the advisor force looks like and how much of a next-gen talent gap we have. So our prediction to that end was that we'll see multi-generational teams increasingly look to solve for dual mandates. So meaning the dual mandate of the retiring advisor who wants to monetize the business, but also a mandate that solves for what the next gen wants and needs, which oftentimes means, I use the word independence, and I don't even necessarily mean like, oh, you got to go start your own RIA. I just mean more of like the English definition of independence, a model that's more free and that has a little bit more autonomy and less bureaucracy and more business friendly, because that's what a lot of times the next gen wants. They want better technology. They want to be able to grow the business and offer these ancillary services. So maybe a tie-in to that would be, I think that in some ways suggests that the puck is heading towards the independent space. And I think we hedged ourselves when we made our predictions. And I'd love to hear your thoughts, Louis, when we said we felt like the independent space would continue to dominate the market, but maybe a little bit more slowly than it had in the past. The pendulum's still shifting that way, but maybe a little bit more slowly. So forget my leading question. Give me your thoughts. Where do you see the puck heading? Do you think the independent space is still the hot space in the market?
Yeah, I mean, I think you're right. We've seen a bit of a slowdown in advisors breaking away for independence. It was and still is a really important topic that every advisor is at least curious about. They all want to know, what does it take to be independent? What are the economics? How is it better for clients? How much work is it? But the truth is, it's only right for a subset of advisors. And I think what's going to continue to happen is, as we're recording this, it's really the first time since 2017 that all four major wirehouses are competitively recruiting with very aggressive deals. So Merrill was the last holdout that got back into the market earlier this year. So I think with four legitimate wirehouse options with big deals, we know that typically advisors who transition more times than not will stay within their industry channel. So that will capture certainly plenty of folks. But then you also have the RBCs and Rockefellers, this private equity concept, as potential takers of market share from the breakaway movement and independence. So it's still important. It's definitely still a hot place to go. I still think it is where the puck is headed. But I think the puck is skating slowly towards the net, and it's never really gonna reach there. It's experiencing a lot of defense, and we still believe very firmly that the wirehouses are a really good place for most advisors who are there, and that you don't necessarily have to be independent to serve clients well, to have autonomy, to have agency over your professional life.
I think that's spot on. And look, I think you said this at the beginning, but everybody asks about independence. You have to be at least curious about it. I mean, most quality advisors, even if you've spent your entire career at Merrill or Morgan or Wells or UBS, you've seen a number of your massive high net worth, sophisticated colleagues make the leap to independence. So everybody's at least curious about it, but that certainly does not suggest that's where everybody ends up. And it does not suggest that's where everybody should end up. I think there are people, to your point, that are just better suited for the wirehouse world. So I think that's a good segue. Let's talk a little bit about the raw data that we saw from some of the wires at the beginning of the year. And Lou, before we do that, you mentioned, because I think this is an important topic, you just mentioned that Merrill has re-entered the competitive recruiting realm. What do you think was behind that decision?
Yeah, I think it'll tie into some of the movement data from Merrill in the first half of 2024. But I think it's no secret that Merrill has had a considerable amount of attrition, well above what their expected or levelized attrition numbers are. So I think part of it is just waking up to the fact that we're losing teams to independents, to wirehouses, to other firms. And we have to start replacing those folks that have left. I mean, it's nothing new that Merrill's losing a lot of teams, but still they held out for a very long time. So I think part of it's probably just waking up to that trend. They do have new leadership of Merrill since Andy Sieg went to Citi. So it could be a change of tide and strategy with new leadership. And I think too, with every firm, the average age of advisors is creeping up. Mm-hmm. It's also just trying to think a couple moves down the board that as more advisors enter CTP, which is their retiring advisor program, as advisors leave, we need more capacity to service these clients. And perhaps just adding advisors into bank branches and trainees is not necessarily getting the results as far as net new assets and organic flows that they're looking for. So my guess is it's probably more on the attrition side, and the new leadership looking at this and being motivated to step back into the ring.
Yeah, I think that's exactly right. I agree. That's why Merrill has re-entered the competitive recruiting realm. To me, it was only a matter of time. They couldn't keep hemorrhaging advisors without replacing the pond. The bigger question, though, I think is, will it work? Probably still too early to tell yet, but do you have any thoughts? Do you think Merrill will have some success recruiting advisors?
I think they will. I mean, in a fairly short sample size, they've recruited some very large teams. They recruited Sal Tiano and team in Palm Beach. That was a $3 or $4 billion team move. They've recruited some very large private bankers, and I'm sure the funnel or the pipeline is just building. So, yeah, I mean, I think it's a matter of time before they're back in the deal flow. But yeah, I mean, advisors stopped thinking of them as an option because they weren't really interested in the market. So we'll see. But I think it's still a very quality firm. They have probably, if not the most aggressive deal, one of the most aggressive deals. So those two facts alone will, I think, put them into the mix quite considerably.
Yeah, I agree. And as a little bit of a teaser or a preview, we are going to publish reports, one of which will be a targeted report on Merrill, specifically on movement to and from Merrill. So we'll dive into the number of advisors who have left and joined the firm. But I did want to note, in the first half of the year, there was over 100 advisors that joined Merrill. Now, they lost over 350 advisors, but still, I think it's nice to see that there are indeed at least replacing that side of the equation, because as we know, the recruiting battle has two sides. One is, can you restock the pond? Can you bring in competitive recruits? And two is attrition. Both of those go into a firm's recruiting success. I don't think we can talk about recruiting success without talking about deals, because deals are obviously, they shouldn't be, and we coach people, they should not be the driver of a move, but they're certainly an important component of a move. Can you remind our audience where deals are? And I know we said we'd focus more on the W-2 or employee space, but let's also give a quick update on independent deals as well.
Yeah, and I think what's even more important than what the deal numbers are is looking at the trends. So how are firms thinking about structuring deals, and what are some of the enhancements or changes or customizations that we're seeing? I think that's an important piece as well. But I'd say in general, obviously, it really depends upon the size of the business, the specific firm, growth, things like that. But in the W-2 employee space, say the wirehouse space, a multi-million-dollar team will likely see a deal that's 3 to 3.5 times their trailing 12. It could be more, could be less. Some of the regionals will be mid twos, some above 300. So the deals are very good. We haven't really seen them necessarily go up in the first 6 months of the year. What we have seen change, though, is that many of the firms have changed the way that they do back-end bonuses or earnouts, where they're reweighting bonuses to the earlier years, where it's easier for advisors to hit the bonus. We've seen some firms include liabilities or lending as part of assets that are captured to, again, make it easier for advisors to hit the bonus. We've seen some firms accelerate notes for a retiring advisor so they can move once and monetize twice, meaning get a recruitment deal and then go into that firm's retiring advisor program at a quicker pace. And I think with all the competition, whether it's the private equity dynamic, it's the regional firms, it's independents, the firms really have no way to back down on deals. If anything, they'll continue to get better. And when you see a firm like Merrill come back into the recruiting pool and they have a really competitive deal, that no doubt has knock-on effects on what the other firms do. And I think, as always, each firm will look at how is our quarter, how's our pipeline, et cetera, and then make some adjustments to either try to ratchet up the amount of flow that they're receiving, or maybe they're comfortable where they are and will just hold the line. But I don't see deals going down. I think they've just gotten better and more advisor friendly. I also don't see them, the headline number, going up by an exorbitant amount either. And then on the independent side, I'd say deals have almost doubled since the beginning of COVID. High interest rates certainly help because the firms, at least for now, make a ton of margin on cash sweeps or net interest margin. So as rates are higher, they're making more money, but they're also facing a ton more competition as well. So deals in the independent space, depending upon the firm, Could be anywhere from zero, if an advisor is launching an RIA or affiliating with an RIA firm, to maybe 100% of an advisor's trailing 12. And some firms will structure deals looking at basis points on assets under management. So depending upon the makeup of the business, the deals can actually be quite more than that. So we've seen definitely deals go up there. And any firm that wants to compete in the independent space, it's now the price of admission has gone way up. For a while, it was 30, 40% of trailing 12 or GDC. That's certainly changed. Where now it's, unless you're 60, 70, 75, 80 or above, you're probably not going to get invited into a process. Do you have anything to add?
No, I think you nailed it. I do think this cash sweep topic is a very important topic and not one to gloss over. So maybe let's pivot ahead now as we think about our predictions because to me, that's more of a forward-looking kind of prediction of because this cash sweep stuff, it seems like is definitely regulatory driven. I mean, just reading the press releases that are coming out of all the various news wires, seeing the number of firms who have been tangled in litigation with this already, it's pretty clear that firms are going to have to get more aggressive, and probably rightly so, with sweeping clients into more aggressive interest-bearing products or more aggressive interest by default, which means margins will shrink. And I would think that equates to firms needing to get more selective with the deployment of capital. So do you expect deals to come down? Do you expect firms to get more picky about who they recruit? What's the impact?
Yeah, I mean, the firms are forced to increase the yield on cash to clients. We know that's a major driver of their profitability, especially the independent broker dealers and the RIA custodians. That's pretty much the whole ballgame for them. So it's impossible for them to still make a meaningful enough return on recruiting a team of advisors that they would keep deals the same. So we have no idea what it's going to look like or how it's going to shake out, or if firms will continue to keep deals the same and just be comfortable with the lower margin because they're looking to keep scaling their businesses. But I don't think it's far-fetched to think that deals, especially in the independent space, will come down to an extent. I don't think they'll come down a lot. They certainly won't go up. But I think you're right that maybe firms they'll take big swings at the right businesses, and maybe won't bid, or they'll be less competitive for businesses that aren't ideal. And maybe they'll pick their growth stocks. If they find a business where they really think it can grow, whether through recruiting or organic means, maybe they're more willing to pay the normal or more aggressive deal, because if the business grows, they're going to make more margin on it as well. So I think too early to tell. I think it's impossible to ignore this and not think it's going to be an issue. I think where it can also crop up is a lot of the large independent broker dealer networks are backed by private equity. Nothing wrong with that. But if a major component of the private equity profitability models is revenue from that interest margin, and the independent business is already low margin, does it cause some trading of private equity firms? Do the firms have to look at cutting costs or increasing fees to advisors? They probably have to make a certain return. And if this is a big part of what the multiple they paid was based on, is this going to have some knock-on effects and cause even more consolidation with broker dealers? I think it certainly will with smaller broker dealers who didn't really have the scale to compete. But if a smaller BD who is already probably challenged by the major incumbents is now losing a big source of revenue, does that cause these firms to sell or to shut down? So who knows what's going to happen? I think you can't just sit back and ignore this. It's going to keep coming up in headlines, and there will definitely be some downstream impacts on recruiting deals, on which firms are competitive, and how firms are pursuing advisors as a result.
Yeah, I think that's right. I mean, the firm needs to make a certain profit or a certain amount of money on these deals for them to be worth their while. And so if their model inputs have changed, and they clearly have as cash sweep margins have changed, there has to be an impact. And that impact, to your point, may very well just show up in a totally different way. Maybe it means firms have a less competitive ongoing payout, or they charge an administrative or a technology fee, but they'll find a way to get their revenue. I don't think we have any doubts about that.
The only way this doesn't become an issue on the recruiting side is if you look cynically at some of the changes that firms have already made. I'm not going to call anyone out in particular, but they made some changes that seem great and they seem benevolent. But if you really look at the details, it only impacts a very small percentage of clients or client accounts. So I think if this is all just about appeasing regulators, it's not about changing the perception of clients or feeling like the need to make cash sweeps more competitive, I think maybe there's a way for firms to do the bare minimum to appease regulators. And then this doesn't really become a big deal. But I don't think it's going to be the case. I think this is going to be something where firms are going to have to be on the offensive about it, or they're going to be stuck on the balls of their feet and have to do something against their will or under a lot of pressure from regulators, from lawsuits, et cetera.
Yeah, I think that's right. Let's talk a little bit about, so I mentioned this earlier, that if you think about the two sides of what dictates whether a firm had a good year on the recruiting front, is certainly you want to bring in assets, but you have to be able to retain your existing advisor force as well. And the question comes up from time to time, well, if the firms are going to spend all of this money, you quoted deals almost 400%. If the firms are going to spend all of this money to recruit an advisor, why not just pay their existing advisors retention deals? So do you think we're going to see that? Are firms going to start to offer retention deals?
I would be shocked if that was the case. A good example recently, though, is KKR in July announced the acquisition of Janney from Penn Mutual. Janney, the very respectable regional firm. So that was an acquisition, so it's a little bit different. But those advisors will likely receive some sort of retention award. The rumor is that there's equity included. So if you take that out, I don't think any other firm is just going to offer retention. They honestly don't need to, because by far, I said it earlier, their best retention tool are sunset programs. If anything, they'll make those deals longer, meaning the inheriting team has to be tied in for a longer period of time. They'll make it more punitive if advisors leave, and they have at their disposal the ability to make those deals even better, because ultimately the team's taking a lower payout and really they're financing the deal, but it's the advisor who's paying for the business out of their own cash flow. So that's going to be the most friendly to their bottom line. You also, if you start offering retention deals, it's forcing advisors to make a decision. It's, well, this is good enough or it's not, or I have to sign a new long-term note. So you naturally will lose advisors in the process. And then you also have advisors who feel like they should get more, or I heard that so-and-so got more than me. So I don't think just offering retention deals is good business. I don't think it's going to happen. And I don't think the firms need to, because they can always increase the competitiveness of their retiring advisor programs, which pretty much serves a similar purpose.
I completely agree. To your point, by even offering retention, it would come with strings attached, and that would have the impact of shaking the tree, and some coconuts would fall. They would lose advisors, which is ironic, but they would lose advisors in the process of offering retention deals. Let's talk a little bit. I hate to end on a pessimistic prediction, but I want to get your thoughts on when we hear, if somebody can articulate a reason for moving, a single reason. A lot of times it's death by 1,000 cuts, but typically from a wirehouse advisor, it has something to do with bureaucracy or bankification or red tape or ease of doing business, or it's not the same place it was. The culture has eroded. I mean, those are all flavors of a pretty similar thesis in my mind. So my prediction, or maybe my question for you is, do you see that easing up at all? Like, we get the question sometimes from advisors, well, if they know they're losing advisors because they're so bureaucratic, why don't they just become more business friendly? And I think my prediction is because they're big, massive financial institutions that handle compliance to the lowest common denominator because they're FINRA managed or FINRA compliant. But do you think we're going to see a little bit of a reprieve here in terms of firms getting more business friendly?
Not necessarily. I do think it's important to say that not every firm is created equal. It's easy to talk about the wirehouses with one broad brushstroke, or independent broker dealers, and group them all together. But there's definitely differences in terms of culture, in terms of where revenue is attributed from, meaning is it most of the revenue of the company is from banking and commercial banking, or is it from wealth management? So there are some major differences in culture, which also can translate to being more business friendly. But I don't necessarily see the firms just changing a bunch of policies. We did see Merrill, to their credit, implement a number of changes that were positioned as we're listening to the advisors. But I think most teams looked at that and said they're minor changes around the edges. It still doesn't solve the major underlying challenges that a lot of advisors face. So I think short answer is I don't see them changing their policies. I think most advisors would say if we knew the firm would be exactly the same for the next 10 years, sign us up, we'll stay. What people worry about, and I think it's a reasonable thing to think about, is that we've seen the pace of change every year, every couple of years, or just looking over a period of time. So 10 years from now, this firm might be unrecognizable, and every advisor is going to be standardized, and a lot of the entrepreneurial spirit that advisors really like about working for any firm and building their own business gets taken away.
Yeah. And I just want to call out again what you said at the beginning there, which is, and myself included, I'm guilty of this too. We talk in kind of buckets or models. So a lot of times the tendency is, oh, W-2 or employee firms, but that's not really fair. There are very important differences among the employee firms when it comes certainly to product and things like that, but more importantly to things like culture and bankification and bureaucracy. So I'm glad you made that point. Let's pivot now, and this will be our last segment here. I want to talk about some representative deals, so some large transactions that happened in the first half of 2024, and partly because I think they're interesting, but partly because of what they suggest about the industry or the street going forward. Let's talk about Alan Verheul, James Wood and team, who left Merrill in Oklahoma for LPL's employee channel, which is called Linsco, and the deal was back in May of this year.
Yeah, so this was actually a team that we had the privilege of representing at Diamond Consultants. What was interesting about this move was a lot of folks think of LPL as an independent firm, but these guys actually joined their somewhat new W-2 model. So this was a team that looked at a lot of different things. Independence was a little bit too much, but they wanted many of the benefits of independence. They wanted to brand themselves. They wanted to own their own business or own their book of business, but offload compliance and real estate and HR. So it was a really good fit for them. It was the best of both worlds. So I think this deal is important because it illustrates that there's a lot of innovation going on across the industry, and the firms that once were competitive may not be anymore. And firms are always innovating new business models, new affiliation models. And I think a big takeaway is don't just assume that because you looked around 5 years ago that everything's the same. If anything, firms are looking to meet advisors more where they are and either see opportunities in pockets that they're missing or look around at their competitors and say, we think we can do this really well and no one's really doing it. So that means that there's more choices that might just hit the nail on the head of what an advisor is looking for. And I think this team is a perfect example because this new model at LPL wasn't around a couple of years ago. So if it wasn't there, maybe they would have just stayed. But in this case, they found their ideal partner, and it gave them a way to monetize the business, get a lot of support for running it, but also have a lot more autonomy with how they serve clients and how they can ultimately monetize the business in the future.
Yeah. And did you say how large the team was? I can't remember if you said it. Sorry if I missed that.
I think they were about 700 million in assets, and they were generating a little bit more than 4 million of trailing 12. So they're definitely a meaningful team.
So I want to talk about another representative deal, and this one is going the other direction. And I'm intentionally wanting to talk about this one because, again, I think there's a little bit of a perception that everybody's fleeing the wires, and that's certainly not the case. So the deal I'd like to talk about is Foley, DeLuise and Associates, which was a team of Merrill lifers. So people who had spent their entire career at Merrill, built a book of over $2 billion, and moved to UBS in February in New Jersey. So part of why I find this interesting is, again, because they went from one wirehouse to another. So clearly they don't view it that all wirehouses are created equal. Secondly, because they were lifers, and I think it's a big deal anytime a lifer makes a change. Thirdly, because of their size, this is one of the larger deals of the year. And then also when we think about, so why would a team like this opt to leave one wirehouse for another? Deal certainly plays a part of it, especially when you think back to the beginning of this year, UBS was offering an incredibly aggressive deal. But to me, it's much more about what Lewis said earlier, which is that there are very important cultural and business differences among the various wires. And UBS has done a nice job of positioning themselves as the boutique of the wires and also the firm that caters the best to the high net worth, ultra high net worth space among the wires. And maybe that's not entirely fair because I think a firm like Morgan Stanley also plays very well in that lane. But UBS has actually made it their policy almost to focus on those relationships at the expense of the mass affluent. I think that's the feedback we hear from UBS advisors is the more down the fairway, less high net worth, ultra high net worth folks are feeling a little bit marginalized. But for a team like this, they fit down the fairway of exactly the type of team that UBS is looking for. And I think importantly, when you look at a team of this size, and I think it was about 8 or 9 folks on this team, we did not do this deal, but it's pretty clear that they were at different stages of the game in terms of where they were in their career. And so while they certainly could have taken Merrill's CTP, their retire in place program, they opted for the path of move once and monetize twice, presumably. So meaning they'll get the recruiting deal from UBS, and then they can enter into UBS's retire in place program, which is called Alpha. So I think a very interesting transaction. Anything you'd want to add to that one?
I'll also point out that I think an interesting dynamic, and I'll give an example, is the fact that as all 4 wirehouses are recruiting, or so many firms are recruiting, that naturally attrition is part of it, right? Firms will lose anywhere from 3 to 7% of their advisors in a given year, typically. But as an example of this, of firms losing one team, gaining another, on June 14th, it was announced that UBS hired a very large team from Morgan Stanley, led by Rory Lindquist and Lowry Boyd. They generated about $4.5 million. And on the same day, UBS lost the team to Morgan Stanley, led by Ryan Dietz, with about $375 million in assets. So, I mean, this is why many of the firms have gotten out of recruiting at different points in time. It's the old prisoner exchange. But we know from doing this that attrition is going to happen. So your choice is either just to take it on the chin and lose teams, lose scale, et cetera, or you accept that you're going to lose teams or put policies in place to try to retain advisors and make them happier, which is hard to do, but more likely is be on offense and look to recruit quality teams to replace the folks that will naturally leave or retire. Let's wrap up here. This was, I thought, a really interesting episode just to get a pulse check on what's going on so far in 2024. We will no doubt publish our 2024 report in the beginning of 2025. But you can also, on this episode page, you can download a copy of our current transition report from 2023, see what movement was last year, see what firms are winning and losing, and go deeper on some of our predictions, many of which we highlighted here. And if you also visit the episode page, you can subscribe for notifications because we're putting out firm-specific transition reports, and you can get notified when they come out and also get notified when the 2024 report is ready for consumption. So, Jason, thank you so much for being our kind of data scientist, diving into the weeds on this stuff, and I think giving me and everyone who listened a really interesting perspective into the state of recruiting in halfway through 2024.
So much fun. Thank you for having me on. I can't wait to come back at the beginning of 2025 to dive in. It's hard to believe it's almost 2025 already.
Curious about where, why, and how advisors like you are moving? Download the latest Advisor Transition Report to learn more, including intel on recruiting deals and our insight and analysis on the latest trends in the wealth management space. You'll find it at diamond-consultants.com/transition report. Or if you'd like to talk, feel free to give us a call at 908-879-1002.